So it's saying that magic minute mitigation times is the start of the continuation of M, which is our manipulation. So it's a continuation of M. That's why we have those mitigations at that time, right? So that's the big aha. Um, Looking at New York, right, we have L first, right, because it's creating internal liquidity mitigation cycle. M, we come into that POI that's come from those extreme range orders beautifully. 1.5 hours after the open, we're in C, right? 90 minutes later, we're in C, which is mitigating there. Obviously, we left some space, but at C, we're not going to go past manipulation. Cool. So next day, Asia have this really nice build up to the upside. We end up, yeah, we'll start from here. We end up moving up in X. L creates equal highs using this as a mitigation cycle high here. M, we take that out. And then guess what? C opens, magic minute mitigations. All right. 30-minute buffer goes to this high here, okay, which is still mitigation of this manipulation with our magic minutes. All right. Again, X, right, because we've reversed from the last cycle. L, right, we're creating liquidity here connected to here. We created POI as well in X. And then M, we spike into there, okay, and then we get a continuation from there. And we opened here, we actually had L X LMC for New York here. So New York opened in L and manipulated within our magic minute mitigation time. With the 30-minute buffer, it would be this low here, and that's perfectly into that POI right there. Cool. So yeah, we want to use this in line with our session opens. Super, super important. Yep, what follows after M, we have C, right? This is a little confusing, so you might have to come back to this, but XLMC London and LMCX New York, the magic minute mitigations are C, within C. LMCX and XLMC, the second magic mitigations are either X or C, and we know X can be a continuation as well as C. Okay. Like we said, we have our second magic minute mitigations 3 hours after the open, and guess what? That's two 90-minute cycles again. So basically, it's just using the next cycle to say we have our magic minute mitigations later because we had a different XLMC or LMCX setup. Okay. Yeah, so we have two potential magic minute mitigation times to correlate a continuation from our manipulation. Use this as an understanding, an additional understanding if it seems a bit too complicated, which it really is. It's just really understanding why we got it, but you could just strictly use these quarterly cycles, and please add it to your system as well, and you'll get it anyway. But I definitely recommend adding, your magic minute mitigation times because they correlate perfectly with this. And the exact same goes for New York as it does for London. We just have different. We just open in the third cycle of. Yeah, we open in the third cycle of London and then we open in the second cycle of New York. Okay. Summarizing time, right? Coming back to this, time will guide us to when we enter, and price will guide us from where we enter. Okay, so let's use our 90-minute for London, Frankfurt, and New York. Little tutorial on how I get it, okay, just to help you guys out. So just a random example, right? Let's just look here. We got Asia. So Asia ends, and write this down, guys, if you can. All right, write it down. I'm just gonna have a sip of water. See if you can get something to write down. Alrighty, alright. So our London cycle starts 2 hours before Asia open. Alright, write that down because our time zones are going to be different, and we're going to have daylight savings or whatever shit going on. But yeah, they will be 1 hour and a half, 90 minutes, right? Just like that. Okay. So start 2 hours before Asia ends, and then we're good to go for our London. How do I get this setting, right? So we go into, where do we go? Where do we go? We go here, right? Fibonacci section, Fib time zone. I'm going to save this as main so I don't lose it. We go Fib time zone here, right? It's going to look like, let me get it to what it looks like for you. It's going to look like some retarded shit like that, alright? So we're going to double click on it. We're going to get rid of 5, 8, 13, 21, 34, all the way to there. So 0, 1, 2, 3. Actually, we need that as well. We're going to change that to 4, just like that. We've got to get rid of labels. We're going to change all these colors to, let's do like light gray. If you have a black chart, just do, should work as well, to be honest, light gray. Get them all the same color, just like that. Okay. If you want to put the opacity down, you can as well. If you want to put the thickness down, you can as well, just by pressing all these. But that's it, right? And then save that, and that'll be your cycles. This will be adjustable, but you just make them 90 minutes. And there you go. And you can also go here, press this star here, and it'll add to your toolbar. So I've got a nice rocking toolbar up here with, you know, the stuff I'll use constantly. Okay. Let's just do like 2 examples real quick, right? We're looking at the London. We got 90 minutes, 90 minutes, 90 minutes, 90 minutes. So we got our London session. What do we got here, right? During this time, we sweep some liquidity and we move up. So we have X. Okay, so we mark X. Right up here, we're creating a push to the upside. But what are we doing? We're taking mitigations of money from this kind of build up here, this trend line build up here, right? We have a point of interest to the left side here, so we'll mark that out as our mitigation cycle. So this will be L, okay? The downside, like down here, will act as a smart money trap if we don't have a load to induce within. M up here, clearly we have a very nice manipulation. This is on the 15. If we go on the 1 minute, we'll get a beautiful, beautiful trade from here. And guess what? Frankfurt opens here. You can also get a trade from here to this level, just following our range rules. Okay. Here, what's this? Beautiful continuation. Right? This is all random. I haven't even looked at this example. Okay. Beautiful continuation to the downside in C. What does that mean? We can trade again from here. Cycle resets. We just attach that perfectly to there, and this will be our New York cycle. The open are these gray boxes here, alright? So what do we got here? We got X, a continuation of this one, so we actually got XLMC again. Got X, L, we're creating these equal highs. We're also adding to this low as an inducement, right? We can find the POI for this, let's do it, right? This adding to an inducement, beautiful POI here actually, just like that. And what's this? XLM. We file after M, right? Beautiful. See, continuations, we don't really create continuations from here because we move to an opposing objective, right? So it's not like it's always going to do exactly what it needs to. It doesn't work like that. You always have to look to the left. But you won't get liquidated in C. Your manipulation entry will stay protected. Then afternoon session starts. We actually did rally in the afternoon session there. It looks like this would be L here, and then M, and then C. We rally up to the upside. We'll look at one more example. Okay. So start 3 o'clock for me, which is 2 hours. I'm going to make this my main. Right. 90 minutes. Okay. X. Right, because we have continuation here. What are we doing straight away though? We got this beautiful retail liquidity up here, right? Super easy to read. We're creating targeted liquidity. We have this break here that we can use. Obviously, I'd like to use that, but it came into the break, which is fine. Swept liquidity, broke structure. It's from our extreme range orders down here. We have internal inducements within here, right? We can look at this as a big channel, right? But yeah, like I said, X, L, okay, we're creating inducement, but we're also creating targeted liquidity in L. M, beautiful manipulation. I'll answer that in a sec. Let me just finish this up. M, right into that POI here. And then C, what do we create? A beautiful continuation from M. So we can buy here. We can buy here. You could sell here, but you know, it's a bit iffy. But because we know we're reaching this target, we can. And then new cycle starts, does the same thing all over again. Okay, let me look if you asked a question. You got to drop for a meeting? No problem, man. You can just watch a replay anytime, of course. All good, bro. And that's some examples of how we can use our timing on the chart. So if you guys want me to make like a separate video of that, just going over even more examples because you're not got the hang of it, definitely let me know. But I want you guys to back test this and see how you go with that. Let me delete all this because we're going to look at the chart again shortly. Okay. So back to this, you know how to get your cycles now. Awesome. So London Open is the third cycle, New York Open is the second cycle. Just keep that in mind, right? You'll obviously see it in the chart, but it's just something to keep in mind. We can use current and previous time cycles to see what the delivery purpose is live in the market. Okay, that's just saying that we got to look to the left. We got to look what the last cycle was, because everything's kind of creating a story to find its objective. That's what we've got to find out. And yeah, just like I said, we must look to the left and follow our range rules to link out key areas of order blocks, traps, etc. Now, we also want to use this on the high time frame to find our overall objectives, and the low time frame for entry and intraday objectives to align with the high time frame picture. So like I've gone on before, we're always linking the high time frame to current price because the high time frame picture controls the low time frame. Right, and on the high time frame we can find our high time frame objectives, which means on an intraday level we could trade towards that objective. Okay. Example, high time frame we might be in C, low time frame we're moving towards our manipulation, right? This means our low time frame objective is reaching the manipulation, but our high time frame objective is to create the continuation. Okay. Time comes first with analysis, right? So I want you guys to be implementing into your system time first. Helps to link inducement concepts to where and why. Okay, high time frame creates a purpose. Links directly to our daily cycle, like we went over in the few slides before. It has a direct correlation, the London and New York, to our cycle. Does this timing concept apply to crypto charts? Yes, it does apply to crypto charts as well, which is awesome. Applies to stocks, pretty much anything with candlesticks, because they duplicate the algorithm to run onto different things. So yes, you can use it in crypto, and I recommend you use it in crypto as well, because you can hold that stuff for longer usually, and even short. Okay. Yeah, like I use the same for stocks on the high time frame because you shouldn't have your money held in a bank. You should invest your money. That's just an opinion, of course, but you know, however you want to do that. Time comes first, right? Just I wrote that twice, but it's important, right? We've got to add this to our analysis. Like I said, space and time. Time will guide us when we should enter. Price will guide us where we should enter. Okay. We already had a 90-minute cycle about why we have them at times. So we actually have had a 90-minute cycle webinar before, but the times given in that webinar are going to be replaced by the times here given in this presentation because they are more effective, right? It still follows the same idea of the CLS delivery. The same thing's still happening, but now we're using it in more of a structural manner. And I must give credit too that even though I developed the objective understanding to these fractal cycles and how to actually use them, I've heard other people, talk about quarterly cycles before. People I've connected with too, which is great. Cool. So now we're moving from time into structure. Okay. But yeah, that time stuff was the main thing. Okay, this is how we're going to implement it into, the other kind of things that the algorithm are doing. Um, but yeah, make sure you guys got some good notes on time. Okay, so the highs and lows are the truth, right? Candles can be deceiving. The market maker truly cares about highs and lows. Example, if we use the line chart. Let me just get a drink real quick. Alrighty, sorry about that. Market maker truly cares about highs and lows. So what I mean by that, if we just go here, we can activate our line chart. And what are we seeing so clearly? We're seeing highs and lows, highs and lows. These are what you should be studying, like realistically. The candles can hypnotize you a little bit into overcomplicating things, but we can literally trade the same way as we do with the line chart, and it's simpler. Obviously, we're not going to do that, but like for example, we have a sweep of liquidity here, we have a break of structure, we have a strong high that formed here, we have a mitigation, internal liquidity, we have a sell opportunity, right? It's the same stuff, it's just finding the peaks and valleys. Um, but yeah, right? So the algo itself really cares about highs and lows because that holds the liquidity. The highs and lows hold the liquidity. Where do everyone put their stop losses? They put them in the highs and lows. Okay, they're not going to put it randomly in the middle. So we need to view structure from end to end rather than getting caught in the middle. Price only goes up and down, but if everyone could trade like that, the markets wouldn't work as there's no targeting liquidity. Trading's not going to be easy. It's not going to make it easy for you. If everything just went up and down, it just doesn't work like that. Everything needs its opposite. You need losers to have winners. Okay. Price develops as continuations. So this is kind of the structure. If we look at this image, continuations, high time frame POI, reversal, continuations of the reversal, repeat. Right. That's what it's constantly doing. Um, and we have more continuations than we do with reversals. So just follow the manipulations, right? Everyone's stuck on like here, stop trying to catch the reversal. Everyone's so stuck and set on just getting the reversal because that creates the big money. But at the end of the day, you gotta respect those continuations because they're much more present than reversals are. Obviously, on a lower time frame, there'll be intraday reversals, and that's how we tackle things with ranges. But just looking at the broad spectrum and knowing everything's fractal, what do we have here? One reversal. How many continuations do we have? About 15, right? 15 to 1. Like, come on. Cool. Um, I don't know why this became a bit low quality, but that's alright. So these are the up and downs of structure, like we'd look on the line chart, alright? And this orange line depicts really what's going on the lower time frame, right? So we got our higher time frame structural narrative, and then we got our low time frame structural narrative, right? So we're kind of dissecting what's happening from the high time frame on the lower time frame, right? But at the end of the day, the high time frame is still the ruler of the price action, yeah. So just here, right, this is just pretty much example, but this is something we will see commonly, right? We'll create a strong low, strong high. That'll create our range on the high time frame. That just looks like a low and a high. Internal inducements, right? Mitigation of these orders, premium discount. We have a range, inducements, mitigation of orders, premium discount, inducements, right? Sell, drop, order block, inducement, continuation, right? It's the same thing, but like I said, it's exactly what we were talking about in our time cycles. Um, each four functions, what do we have to have? We have to have liquidity, manipulation, continuation, and X, right? For the next cycle. That's what's happening on the lower time frame. Cool. Now we're just looking into ranges a little bit. We have looked into ranges a few times before, but like I said, I want to make sure everything's kind of condensed under the same umbrella, right? So we know how to trade our ranges, but why do they work, and how can we use them more effectively or effectively? So extreme range orders, why do we have extreme range orders, right? Why are they so important? Because they come from external higher time frame inducements. When we're within a range, we have internal inducements to get to the externalized points. That's why we only want to trade from our external inducements, and internally we can trade towards them. That's our range rules. You should know these range rules off by heart. If you don't know them off by heart, you need to. Okay. We want to use external inducement orders rather than internal if we're looking to trade out of our current working range. Right? This is fractal and can occur on every time frame, even the M1. Right? So I like to wait for my M5 range, but you can do M1 ranges. Right? This works on any time frame you want. If you have an M1 range, just follow your range rules, trade with your inducements, and you'll be making absolute bank just from doing that itself. Right? That's all you really need. So yeah, but I recommend you stick to the M5 Plus if you want to go M1 scalping. You know, good for you. That's awesome. But you have to get a good understanding of the range rules, which are just formed from the fact, like I said, that external inducements are much stronger and have those high time frame orders within them from the high time frame order flow. That's what we want to be using. Internal inducements act as smart money traps, and we're going to go over this now. So the smart money traps are the external inducement smart money traps, right? Meaning that these are smart money traps because of these external inducements. It belongs inside of it, which it pretty much does, right? It's inside of those external inducements, strong high to strong low. It's inside of our range. But yeah, what does this say? Internal strong highs and lows can be traded back to the extreme range order flow. That means if we are reacting from an internal strong low, say this did react, we can't trade it higher, right? We're not allowed to trade it higher. We can only trade it back to our extreme range order flow because of the fact that we can only trade extreme range order flow to the opposing, right? Until face off, trade it out. It's got to mitigate the extreme range, right? So there may still be a reaction that is tradable, but we know the overall outcome based on our range rules. So we got the bigger picture sorted. So know this up by heart, and I can make a mini video going over some examples as well. But we did that in another webinar, so check that out. For example, this smart money trap, because it's disconnected from these extreme range orders. So this can get a reaction, but it will not hold and break this high because it's not following extreme range order flow. You can't trade out of the range until that is mitigated up. That's the power of these external inducements, okay? Yeah, these become smart money traps when we grab the extreme range orders above. Yeah, because we're grabbing these extreme range orders here, we can only trade to these extreme range orders. We do not trade to these. They're traps. Why? Because they're internal strong highs or strong lows. They create inducement pullbacks rather than reversals. So your high will remain protected, and you can trade from that high any day you want, any time you want, any way you want, until we reach our opposing extreme range orders. Right? I know you guys have seen this 1,000 times, but we're just going to quickly link what we've learned. This is the same thing, but for a bullish impulse example. So we know how to trade our ranges, but why do they work and how can we use them more effectively, right? So ensure your strong highs and lows are matched to the opposing of the same time frame, right? So let's say this is a 15-minute strong low. This has to be a 15-minute strong high to actually form the range. You can't have a 1-minute strong high, right? And then link it to this, right? Because it won't go down to that. It'll just pull back here and continue to the upside. You could have a 1-minute strong high here and a 1-minute strong high here. They would link, right? But this is a 15-minute, this is a 15-minute. Now we have our range rules. We have to trade this to this. This can move up internally, however the fuck it wants to do it. We're just using mitigation in that sense, but follow the range rules, right? And follow premium discount as well. Use predeterminism within our ranges. For example, you can't really see it here, right? But did we leave like extreme range orders? Well, in this case we did. We left them here. So we know this is going to come get tapped eventually. So we're creating predeterminism for supply, right? Premium discounts needed for every range except minor inducement pullbacks. We went over this last time, but minor pullbacks create fake reactions and will not always come to that 50%. So this supply up here has to react to a valid supply. Can't be a smart money trap, can't be already mitigated, because if it was, and it was a minor inducement pullback here, then then this might pull back straight up and it won't follow the range rules. So ensure that we're reacting from valid areas at our extreme high and our extreme low. Okay. When we leave both our supply and demand extreme range orders, the one we induce into first often makes the other side a trap when following high time frame momentum. So if we come down, right, and then we hit induce into this demand first, it's very common for this supply not to hold, right? So it's like a who taps first wins it kind of thing going on here with our ranges. But not always, okay? Not always will that happen, but it's very, very likely that that does happen. If we induce into here first, this will end up being a smart money trap where we use it to pull back and continue to the upside. But we've got to be coming from this strong impulse of high time frame momentum. Let me read this last one and answer your question. Always identify the RMI, the range made inducement. What is the inducement that created our range? Well, here it's this one, here, because this created the strong high and then it linked to this. Okay, so that's our range made inducement. And you can follow these rules here as well, which are very, very helpful. And yeah, this will create your answer to who's the range winner. Obviously, it's more so used as a confluence. We want to use pure price action for the answer to that, but it'll help you identify whether we have an inducement pullback, so a continuation from this demand, or a reversal from where we come down, hit into this supply, take that bottom out. Okay. In some situations, we're forced to connect a 1 hour strong high to a 5 minute strong low. What should we do in that scenario? But you said same time frame. Yeah, so it's got to be the same time frame. If you're forced to connect a strong high to a strong low, this scenario, right? And we actually are going to go over something like this, right? But if we have a 5 minute strong low here, and then we have a, let's say something like this, maybe 1 hour strong high, this could be our 1 hour strong high here, but we still have a 5 minute strong low that can be present within that 1 hour strong high. So it's still actually valid to connect these points as a range, even though we have a 1 hour strong high here. But because we have a 1 hour strong high, it means we can trade through this, through this low, because we have to come down to connect to the extreme range orders of the opposing 1 hour strong low. So let's say that's down here, right? So we can trade like this. This will end up being a smart money trap because we're in a higher time frame range, and then we can trade to here, and then the market can do what it wants from there, just like that. So we can identify lower time frame within a higher time frame strong high. Hope that answered your question there. Okay. Cool. Next slide. Just gonna get some water. One sec. Alrighty, so point of decision. Like I said, we're going to go over this, and I hope you have a good idea of what this is, but let's go over it. So, for a range strong high or low to be confirmed, we need to displace past the break. Okay. The market often uses this level of decision to either displace or not as a form of inducement. Rather, it is a manipulation. Okay, so looking at here, this is the high time frame of this. So this is on the M5, this is on the H1, okay, but they're the same. So what do we have here? We have a sweep of liquidity, and then we have the high that created that sweep. Okay, so what happens if we displace above this high? We create a 1 hour strong low. It would then link to this 1 hour strong high, right? But instead, what do? We wicked over it tricking chalk traders or people who change a character who don't really know what's going on, tricking those people into thinking we're creating a reversal from this point. Instead, we manipulate these highs, create a continuation from it, and run to the downside. We can use our time, quarterly cycles as well within this to understand that this is a manipulation as well.